Welcome to From Idea to Empire, the life cycle of an investment. Today, we're unlocking the secrets of how a startup secures funding and scales to global success. This video is for anyone curious about the journey of businesses, from a simple idea to a thriving enterprise. Have you ever wondered how groundbreaking ideas transform into massive companies? How do startups get the money to grow, innovate, and eventually become household names? That's what we're here to explore. The investment life cycle is the complete journey of a business, from its very first spark of an idea to becoming a global player. It's a fascinating path involving various funding stages, strategic decisions, and pivotal moments. It illustrates how initial visions transform into valuable enterprises, showing how capital fuels innovation every step of the way. We'll trace this path, demystifying each phase so you can understand how ideas truly become empires. Every great company starts with an idea, but an idea alone isn't enough. It needs fuel to ignite and grow. The early stages of investment are all about finding that initial spark. Bootstrapping is the purest form of startup funding. It means building your business with minimal external capital, primarily using personal savings, early revenue, or small loans. It's about grit, resourcefulness, and proving your concept on a shoestring budget. Once bootstrapping takes an idea to a certain point, founders might turn to crowdfunding. This involves raising small amounts of money from a large number of people, often through online platforms. It's a great way to validate your product and build a community around your vision. As a startup gains traction, accelerators and incubators come into play. These programs provide structured support, mentorship, resources, and often initial funding in exchange for a small equity stake. They help fast-track growth and prepare companies for their next funding rounds. With initial momentum from early-stage funding and support, a startup is ready for its next big leap, the seed to series rounds. This is where external professional investors begin to seriously get involved. Angel investors are high-net-worth individuals who provide capital for a startup, usually in exchange for convertible debt or equity. Seed funding is the very first official equity funding stage, designed to help a company get its initial product off the ground, conduct market research, and build out its early team. Series A funding is typically the first major venture capital round. At this stage, investors are looking for startups with a proven business model, consistent user growth, and a clear path to profitability. The goal is to optimize the product and expand the team to meet growing demand. After Series A comes Series B. This round is all about scaling operations. Companies use this capital to develop new products, enter new markets, or make strategic acquisitions. It's about moving from proving your concept to rapidly expanding your reach. Series C funding is for established companies that are looking to rapidly expand their market share, often globally, or to acquire competitors. At this stage, companies are often valued in the hundreds of millions or even billions and are seen as leaders in their respective industries. After successfully navigating through the early and growth stage funding rounds, companies typically aim for an exit strategy. This is the point where early investors and founders realize their returns, and the company enters a new phase of its life cycle. Major buyouts occur when a larger company acquires a smaller one, often for strategic reasons like gaining market share, acquiring technology, or eliminating a competitor. This can be a lucrative exit for the acquired company's founders and investors. Mergers and acquisitions, or M&A, refer to the consolidation of companies. A merger is a mutual decision to combine, while an acquisition is one company buying another. Both are powerful strategies for growth, synergy, and market consolidation. The initial public offering, or IPO, is arguably the most publicized exit strategy. This is when a private company first offers shares of its stock to the public, typically on a stock exchange. An IPO raises significant capital and allows the public to invest in the company's future. From a bootstrapped idea to a publicly traded company, the investment life cycle is a dynamic and complex journey. Each stage plays a critical role in transforming vision into value. We've explored how a simple concept evolves through various funding stages, from initial bootstrapping and crowdfunding to angel rounds, venture capital series, and finally, to major buyouts, M&A, or an IPO. It's a testament to human ingenuity and financial engineering. Understanding this life cycle is crucial for anyone interested in entrepreneurship, finance, or simply how the world works. Capital isn't just money. It's the fuel that drives innovation, creates jobs, and shapes our future. Thank you for joining us on this journey through the investment life cycle. If you found this video insightful, please like, share, and subscribe for more content that demystifies the world of business and finance. For more in-depth resources, stay tuned with us.